warm welcome and thank you for making the time and space to attend the fifth webcast of the CDOR Transition Series brought to you by the Canadian Alternative Reference Rate Working Group and our host, TMX. I'm JP Mendes, Director of the Regulatory Programs for Global Banking Markets at Scotiabank. I'm one of the co-chairs of the Communication and Outreach subgroup of CORRA. The end of CDOR will have major implication in the Canadian financial landscape. And by presenting these webcast series, our objective and mandate remains the same. Educating market participants on key industry updates and milestones to help you navigate and tackle outstanding challenges in this transition journey from the Canadian offered rate CDOR to the Canadian overnight repo rate average CORRA. The previous webcasts provided you context and insights on term CORRA, which use will be restricted to loan products and derivative linked to a loan. A better version has been published in early July for informational purposes, and the official launch for 1 month and 3 months term CORRA is expected early September this year. Today's sessions will be primarily focusing on transitioning loan from CDOR to CORRA. A panel of industry experts has been put together to deep dive into this topic. This session will be moderated by Carol McDonald, co-chair of the loan subgroup, Managing Director and Head of Portfolio Management for Global Natural Resources for BMO. I'll let Carol introduce herself, and a fellow panelist will provide the insights on CAR's recent publication related to the loan market and share key considerations and important dates for borrowers to factor in as part of the transition roadmap. Over to you, Carol.
Welcome to our webcast for CORRA's Loan Subgroup. My name is Carol McDonald, and I am the co-chair of CAR's Loan Subgroup as well as a CAR committee member. I am also the managing director and head of portfolio management for Global Natural Resources at BMO. The Loan Subgroup was established by CAR to plan for the transition of the Canadian loan market from CDOR to CORRA. We have published a paper outlining the best practices for the CDOR to CORRA transition as well as CORRA loan conventions. The objective of this webcast is to touch on the highlights of these publications and discuss key considerations for borrowers as they prepare for loan transition to CORRA. I am joined today by 4 panelists and subject matter experts in their field of practice. I will ask each panelist to introduce themselves. Mike, we will start with you.
Thanks, Carol. Mike Elsey, Managing Director in Corporate Banking at RBC Capital Markets.
Hi, I'm Lisa Mantello. I'm a partner at Osler, Hoskin and Harcourt in Toronto in financial services. I am also the co-chair of CAR's Accounting, Tax and Regulatory Subgroup.
Hi, I'm Sarah Patel. I'm Senior Vice President and Head of Business Transformation for Global Banking and Markets at Scotiabank, and I'm also the co-chair of the Operations and Infrastructure Subgroup.
I'm Robin Das, Managing Director and Head of Canadian Interest Rate Derivative Trading at RBC. I'm also RBC's Capital Markets Lead for the RFR transition, and I am co-chair of CAR's Derivatives Subcommittee.
Thank you. Mike, Lisa, Sarah, and Robin, thank you for joining us today. Mike, I will start with you first. CAR has published a CORRA transition roadmap to outline key transition milestones. Mike, when considering the transition timeline for loans, what are the key dates that borrowers need to be aware of?
There are 3 dates that borrowers should keep in mind. The first is that we expect term CORRA to start being formally published this coming September, and therefore we expect market participants will begin converting loans from CDOR to CORRA starting in Q4 2023. The second is the no new CDOR or banker acceptance deadline of November 1st, 2023. This means that new loans and any amendment or tenor extension initiated after November 1st need to reference CORRA instead of CDOR or BAs. The third and final key date to remember is the outright cessation of CDOR at the end of June 2024. All loans will need to have transitioned to CORRA prior to that date.
Thank you for highlighting those dates. Next, can you please outline the key points that borrowers will need to consider when transitioning from CDOR or BA-based loans to CORRA?
Sure. When discussing the rate transition with their lenders, I'd recommend that borrowers think about the following. Number 1, selecting the CORRA rate. CORRA is recommending either compounded CORRA in arrears or term CORRA as the replacement borrowing option for CDOR and recommends that only one rate be available in the loan agreement. When choosing between rates, borrowers should consider both operational considerations and their hedging needs. For example, compounded CORRA and arrears might be more appealing to active hedgers of their interest rate risk, as hedging compounded CORRA will likely be more cost effective relative to term CORRA. On the other hand, term CORRA will appeal to a large segment of both commercial and capital markets participants because of its simplicity and ease of use. In particular, being able to know the interest rate in advance and the calculation itself being more straightforward. Number two is negotiating the credit spread adjustment, or CSA. Similar to the LIBOR transition, the purpose of the CSA is to replace the credit component of the benchmark rate that is being lost by moving from a credit sensitive to a risk-free rate. The CSA can be incorporated as a standalone adjustment to the loan pricing calculation, or by directly updating the interest rate margin or pricing grid for the loan itself. We'd note that the fallback CSAs were not intended to be used for new loan agreements where market conditions at the time may dictate otherwise, and hence the need to review and potentially revisit the CSA. And the final item to consider is the timing for amending documentation. As mentioned earlier, there's a relatively tight timeline for existing loans to be converted from CDOR to CORRA. Any borrowers that are planning an amendment or extension between the end of September 2023 and June 2024 should use it as an opportunity to replace CDOR with CORRA. If no broader amendment and/or extension is planned prior to June 2024, then it will require processing a standalone amendment to update at a minimum the reference rate and borrowing mechanics under the loan itself. Relying purely on fallback language isn't recommended, given that CORRA will require more changes to the operational mechanics, given that borrowing by way of BAs will no longer be an option.
Thank you, Mike. That is a great summary of considerations, and I want to emphasize the timing for conversion is really important. Therefore, I'd encourage borrowers to start these conversations with their banks early. This leads into our next topic, remediating loan documentation. Lisa, you've been central in drafting the CORRA Loan Conventions document that has been published in conjunction with the best practices for loan remediation paper. Can you please highlight some of the key changes that will be required in loan documents transitioning to CORRA, including changes related to bankers' acceptances?
Sure, thanks, Carol. I think one of the most important changes to our transition to CORRA does have to do with that there will be no more bankers' acceptances on offer. So the date that Mike did mention, the November 1st date of 2023, is very important because this is the date where CORRA is recommending no new BAs, and BAs were fundamental to the way CDOR loans worked in our Canadian credit agreements. So that's something very important to keep in mind, that those BA mechanics will no longer be there. In its place will be the mechanics for term CORRA and the mechanics for compounded CORRA. CAR has suggested that both of these mechanics are available to borrowers, but only one of them would be used at a time. I should make a note that, as Carol did mention, we have put out a credit agreement, which is a recommendation. I should note that it is not a credit agreement in its entirety, but rather just the mechanics of the loan. So it does go through the interest rates available, the payment periods, and the general operations of the loan. One thing that is new to this credit agreement that the Canadian market has not seen is the flip concept. And this goes back to what I mentioned about having both term CORRA available and daily compounded CORRA available, but not at the same time. Our recommendation is that not both of those options are available at the same time for operational simplicity, and that is what our credit agreement has recommended. However, there is the availability for a borrower to make a switch between term CORRA and daily compounded CORRA. And the reason for that is our experience with what has happened in the US market is that US borrowers who have put in term SOFR have gone back to their lenders and have asked for amendments to those loan documents to put in daily SOFR. So we have tried to address this concern by putting out a credit agreement that allows for both and a switch between both.
Thank you, Lisa. That's a great summary. And thank you for highlighting the two key differences in the Canadian loan market, which are the bankers' acceptances and the rate flip we've introduced. Those are unique as compared to the US and the UK, which did not have those features. Sarah, as the co-chair of CAR's operations subgroup, you spent a significant amount of time assessing the readiness of the Canadian market to accommodate the transition from CDOR to CORRA. I have a two-part question for you. First, can you comment on the readiness of the Canadian banks and their vendors for the transition? And second, how does the transition to CORRA compare and contrast to the transition to SONIA and SOFR?
Thanks, Carol. So the Canadian banks and global vendors are well prepared to facilitate the CDOR to CORRA transition, leveraging the lessons learned from the LIBOR transition. And this includes ensuring client awareness and readiness to move away from CDOR. The approach will be aligned with what was undertaken for LIBOR and ensuring key operational processes and systems are able to support an overnight rate, in this case, CORRA. However, it's worth noting some key differences. A significant portion of the Canadian borrowers are commercial and wealth clients who are largely not impacted by LIBOR transition. These clients will need to be informed of the impending cessation of CDOR and the need to transition their portfolios to an overnight rate such as CORRA. The banks have been conducting broad communication campaigns to inform the clients, and the bank's client coverage teams have facilitated bilateral discussions to address any client queries. Another key difference is the tightened timeline, which I think Mike mentioned, to transition both existing and new contracts from CDOR to CORRA. And in contrast, there was more time available for market participants to transition their LIBOR contracts. Finally, CDOR will permanently cease after June 2024, with no expectation that there'll be a synthetic rate, which emphasizes the urgency to ensure all contracts are remediated by the cessation date.
Thank you, Sarah. That is great perspective and should give the market confidence that we are well prepared for benchmark reform in Canada. I also agree with your call to action for transition given the tight timeline. It really does deserve everyone's attention. Robin, moving over to you, can you please address hedging and what clients who have existing hedges on their loans need to consider when transitioning their loans to CORRA?
Carol, the most important thing for people who have hedges to their loans to consider is to make sure that they're transitioning their derivatives in line with the way that they're transitioning their loans. The vast majority of CDOR swaps use CORRA in arrears as their fallback. This is the fallback that's used by the clearinghouses for all cleared swaps, and it's also the fallback that's used by ISDA. So any clients who have signed the ISDA protocol and any derivatives that are transacted under the 2021 ISDA definitions, which is basically any derivative traded after January 2021, will be using this as the fallback. So any clients who aren't planning on transitioning their loan using CORRA in arrears as their loan index will need to amend their derivatives.
Great. Thank you, Robin. The next question I have for you is with respect to the two CORRA borrowing options. We have compounded CORRA in arrears and term CORRA. For clients that plan to hedge, what should they consider when selecting between the two CORRA rates for borrowing?
Clients who want to hedge their derivatives will find it most efficient by using CORRA in arrears for their loan and then hedging with a CORRA in arrears derivatives. That's the standard derivative index, and it's the most efficient way of doing it. Clients can use term CORRA for their loans and hedge with a term CORRA swap, but this is likely going to be a little bit more expensive as standard swaps are CORRA in arrears, and there's likely to be a material basis between CORRA in arrears and term CORRA, like we've seen in the US with term SOFR and SOFR in arrears. And there also may be increased capital costs as well.
Great. Thank you, Robin. This concludes our webcast. We hope that you have found this discussion helpful. I would sincerely like to thank our panelists for joining us today. Thank you and have a nice day.
Thanks.
I would like to thank our industry expert for providing colors and perspective on how to best address the loan transition from CDOR to CORRA. I'm going to take a couple of minutes to wrap up, hoping that you're able to pick up key themes discussed in this webcast. Here are some of the key takeaways borrowers and market participants must keep in mind. Given the strong demand in the market for a forward-looking rate, term CORRA is expected to be published in early September 2023. The second one, which is related to the no new CDOR and BA milestones, is effective November 1st, 2023. In other words, after that date, all new loan agreements must reference CORRA, term CORRA, or prime. New contracts are defined by any agreements that creates additional CDOR or BA exposure, as well as material amendments, changes in pricing, terms extension, require lending consent, and facility amount increases to existing loans agreement. However, there's a quick caveat to consider here. Drawdown on existing loan facilities executed prior to November 1st, 2023 is still permitted until June 28, 2024. This milestone is to ensure that existing contracts have robust fallback language that includes a clearly defined alternative reference rate. To conclude, CDOR will reach its final retirement on June 28, 2024, and is critical for businesses to understand how they may be affected as market regulators and companies acclimate to life after CDOR and the various transition deadlines and key dates highlighted in this webcast. That said, it is imperative that you are aware of these milestone dates and engage your financial institution in this process as early as possible. Thanks again for watching, and given the scale of the shift from CDOR to CORRA, stay tuned for our next webcast. The upcoming one will be on bankers' acceptances.